You know that feeling when you're watching the ocean? Sometimes it's calm, sometimes there are these huge, powerful waves. If you're a surfer, well, you don't just avoid the big ones, you learn to ride them.
Hmm.
The economy, it's kind of the same. It's got waves, it moves in cycles, these swells and dips. And some investments are built precisely for riding those economic currents.
Yeah, they really are.
Today, we are taking a deep dive into those kinds of investments, the ones we call cyclical stocks. These are the companies whose performance is tied, like, really tightly to the ups and downs of the overall economy.
Exactly.
We've got a stack of reports here looking into these movements with a particular focus on two major sectors that really show this cyclical nature: consumer discretionary and industrials.
That's right. And our mission today is basically to unpack what makes these sectors tick. How their performance usually links up with different stages of the economic cycle, and maybe most importantly, what the analysis in these sources suggests about how you might approach analyzing and, well, potentially navigating these economic swings.
So this is about getting informed on how to maybe ride these market waves, not just get tossed around by them.
Precisely. It's your shortcut to understanding that dynamic.
Okay, let's unpack this, gun, starting right at the beginning. What actually sets cyclical stocks apart from, say, other stocks?
Well, at their core, cyclical stocks represent companies selling goods and services that consumers and businesses tend to see as non-essential but desirable.
Okay, desirable but not essential. Like what?
Think about the things you might put off buying or maybe just do without entirely if money gets tight or you're feeling a bit worried about the future. It's the opposite of non-cyclical or defensive stocks.
Right, like the sources mentioned food companies, Ahold, Delhaize, or Unilever, for example. People always need groceries, right? Recession or not.
Exactly. Demand for their stuff is pretty stable. So the strong tie for cyclicals comes from that discretionary nature. When the economy is buzzing, unemployment's low, wages are up, people feel confident.
They spend more freely.
Yeah, they have more disposable income and they feel secure enough to make those bigger, non-essential buys. Maybe a new car, that big vacation they've been dreaming of, fixing up the house, or getting the latest tech gadgets.
And businesses too, right?
Oh, absolutely. Businesses feel optimistic. They're much more likely to invest in new equipment, expand their factories, or commit to those really big capital projects. And all that spending just surges demand for goods and services from these cyclical companies.
Okay, so that's the upswing.
Yeah.
What about the flip side? When the economy slows down or, heads into a downturn?
That's when you really see the impact. Consumers and businesses, they pull back. Those discretionary buys, the big capital projects, they're often the first things put on hold or cut altogether.
Makes sense. You tighten your belt.
You do, and because these companies are so sensitive to that drop in demand, their sales, their profits, and their stock prices can fall pretty significantly, sometimes dramatically.
So their performance really mirrors the economy's peaks and valleys, but maybe in a more exaggerated way.
That's a good way to put it. Much more dramatically than those defensive sectors we talked about.
So it's not enough just to know if the economy is doing well or poorly right now. You have to understand the whole cycle.
Absolutely critical. The economy doesn't just go straight up or straight down. It follows these cycles. Now, no two cycles are ever exactly the same, but our sources describe a kind of typical pattern, usually 4 main stages. You've got recession, then recovery, then expansion, and finally a peak before things might contract again.
And here's where it gets really interesting. And honestly, a bit counterintuitive for a lot of people investing. The stock market isn't just reflecting what the economy already did.
No, definitely not. And this is maybe the most critical takeaway from these sources. The stock market is fundamentally a leading indicator. It's always looking ahead.
Leading, meaning it anticipates.
Exactly. Investors are constantly trying to figure out the future, usually looking ahead, say, 6 to 9 months. So what does that mean? It means stock prices can start going up, anticipating an economic recovery, before the official economic numbers actually look good. Before unemployment starts falling, or GDP growth turns positive.
And the opposite is true, too.
Yep. The market can start falling, anticipating a slowdown or even a recession before the official data clearly shows things are going south.
Wow. So if you wait for the government reports to confirm a recovery, you might have already missed a big chunk of the potential gains in cyclical stocks.
That's precisely the challenge when you're trying to time these things. You're not reacting to what's happening now. You're trying to position yourself for the next phase of the cycle, the one the market's already trying to sniff out.
Okay, so what actually drives these big economic waves? One perspective highlighted in the sources from Ray Dalio points to some major forces at play.
Yeah, Dalio talks about productivity growth being the sort of long-term engine driving the economy generally upward over time. But the big swings, the really pronounced booms and busts, he pins those mainly on debt cycles.
Debt cycles.
Right. He makes a distinction between short-term debt cycles, maybe lasting 5 to 8 years, often tied to how central banks manage interest rates, and then these much longer-term debt cycles that can span like 75 or even 100 years.
And his really key point is that the amount of credit out there is just vastly larger than the actual amount of physical money, right?
That's the crucial insight. All that credit can fuel these absolutely massive expansions because borrowing lets businesses and people spend and invest way beyond just the cash they have on hand.
But it cuts both ways.
Oh, definitely. When that credit bubble tightens up or even bursts, the contraction has this disproportionately huge negative impact on the economy. And you see it especially in sectors that rely heavily on big borrowing, like infrastructure, real estate.
Huh.
Those are super sensitive.
The sources used an example from India's real estate sector, didn't they?
Yeah, showing these multi-decade booms and busts that were clearly tied to credit growth and contraction. It makes the point really vividly.
Okay, so the scale of the swings is heavily influenced by credit. And you mentioned earlier, different sectors kind of catch these waves at different points in the cycle. That's this idea of sector rotation.
Exactly. Sector rotation is just the observed tendency for different parts of the market, different sectors, to do better or worse relative to the overall market at various stages of the economic cycle. It's like different kinds of stocks get their moment in the sun depending on where we are.
And the sources mention Sam Stovall's model, which is kind of a classic way to think about this.
Right. According to that theory, thinking about the phases, during the early contraction phase, that's often when central banks are cutting interest rates to try and boost things. Sectors like consumer discretionary and financials tend to start looking strong.
They anticipate the recovery first.
Kind of. Then as the economy actually moves into early expansion, that's when you often see industrials, especially things like capital goods, services, transportation, really take the lead.
But I noticed in one of the diagrams, it seemed like consumer discretionary was also linked to the late contraction phase. What's going on there?
That's a great pickup, and it really highlights the nuances here. It suggests that, smart investors might start buying into consumer discretionary stocks even before the official recovery is obvious, basically betting that consumers are about to open their wallets again soon.
So these models are frameworks, not exact roadmaps.
Precisely. Frameworks, not crystal balls. The timing can shift depending on the specifics of each cycle. But the core idea holds. You need to be thinking ahead about which sector is likely to benefit next.
And the economic data that comes out, the reports, they give clues to investors looking to make these shifts.
Absolutely. How the actual data compares to what analysts expected can really move things. If data comes in higher than expected, that's generally seen as good news for cyclicals, suggests stronger growth ahead.
And lower than expected.
That tends to make investors favor defensive stocks because it signals potential economic weakness. Investors are constantly reacting to these signals, adjusting where they put their money.
All right, let's dive deep into our first big focus sector then. Consumer discretionary. The sources gave us a pretty detailed look here.
Yeah, and it's an incredibly diverse sector. I mean, it covers a huge range of stuff. Automobile components, actual automobiles, broadline retail, think big department stores, distributors, diversified consumer services like rental places or repair shops, hotels, restaurants and leisure, household durables, so furniture, appliances.
Keep going.
Leisure products like sports gear and toys, specialty retail niche clothing, electronics stores and textiles, apparel and luxury goods. It's a massive bucket.
And that sheer breadth must mean performance isn't the same across the board.
Not at all. The demand for a brand new car behaves really differently from, say, spending at a fast food joint or buying a new sofa. They're all technically discretionary, but their sensitivity to the economy can vary a lot, especially depending on, the income level they're targeting.
It's a pretty significant chunk of the overall market too, isn't it?
Yeah. As of late 2023, it was about 10.9% of the S&P 500's market cap, making it the fourth largest sector. and its total market value was huge, around $8 trillion dollars as of early 2024.
The graph in the sources, the one comparing it to the S&P 500, it really paints that cyclical picture clearly: bigger ups, bigger downs.
Definitely you see those amplified swings. And looking at recent performance, 2023 was a monster year for the sector. It returned, 41.04%, way ahead of the S&P 500's 24.58%. That's pretty typical behavior during a strong market recovery and expansion phase.
But things look like they were shifting a bit in early 2024.
They did. Year to date, as of early 2024, the sector was actually lagging the S&P 500 slightly. It was up 3.4% versus the index's 4.4%. Now, that change in relative performance, well, it could be interpreted as the market starting to factor in a potential economic slowdown, or maybe just moving into a later stage of the cycle.
And when you look inside the sector at the different industries, the performance differences are just massive.
This is so important for anyone listening. The sources showed, for example, over the past 5 years, broadline retail was up a staggering 169%, but leisure products down almost 49%.
Wow.
Even just looking at the prior year, automobiles were slightly negative, down 0.6%. So that huge range just hammers home the point. Investing in consumer discretionary isn't one single bet. You really need to understand the specific industries and companies within it.
So what are the core strengths and weaknesses driving this sector? The SWOT analysis seemed like a good way to break it down.
Yeah, the strengths are pretty clear. That huge breadth of products, meaning they can capture spending across lots of different consumer needs. There's constant innovation, especially with tech and creating new experiences. Surprisingly, there's often resilience in certain segments, even when times are tougher. And many big players have a global reach, tapping into growth overseas.
But the weaknesses are kind of baked into the definition of cyclical, right?
Pretty much. That high sensitivity to the economy is the big one, making earnings really unpredictable. The cyclicality itself makes forecasting tough. Then you've got risks from changing fashion trends or consumer tastes, especially for apparel and luxury. And they're definitely vulnerable to supply chain problems, which we've all seen recently.
What about the opportunities ahead?
Well, e-commerce is still a huge driver, changing how people shop. Rising incomes in emerging markets create massive new customer pools. The whole health and wellness trend opens up new product areas. And technology, things like AI, augmented reality, even 3D printing, offers ways to improve the customer experience or make operations more efficient.
And the threats. What keeps executives in this sector up at night?
Economic downturns are obviously the biggest threat, hitting spending hard. Intense competition is a constant battle, maybe even more so now with direct-to-consumer brands popping up. Then there are regulatory risks around product safety, the environment, labor, data privacy. Those can add costs or change how they operate. And of course, geopolitical uncertainty can mess with supply chains and global sales.
Okay, let's connect this back to the big picture economy. The sources looked at specific data points influencing this sector.
Right. They mentioned PCE inflation, which was running at 2.8% in the data they cited, still above the Fed's 2% target, putting pressure on what consumers can actually buy. Unemployment was low, 3.8%, which is good for incomes, but job growth seemed to be slowing down a bit.
And the Fed.
Holding interest rates high, between 5.25% and 5.5%, and still doing quantitative tightening. That makes borrowing more expensive for everyone, consumers and businesses.
So it's this interesting mix: high inflation, high borrowing costs, but still a pretty strong job market keeping incomes up.
Exactly. It's a complex environment. And the sources also brought in Fidelity's view from Q1 2024, saying the U.S. economy was likely in a very late expansion stage. Now, that perspective matters because, as the analysis pointed out, consumer discretionary typically doesn't do well during contractionary periods.
So that slight underperformance in early 2024 might fit that narrative. The market anticipating a potential shift.
It could definitely be seen through that lens, yeah. The market potentially looking ahead to choppier waters.
The report also dug into the sector's financial health, comparing it to the overall S&P 500.
Yeah, they looked at key metrics like return on equity, ROE, how well companies use shareholder money, earnings per share, EPS growth, how fast profits per share are growing, return on assets, ROA, efficiency with assets, and net profit margin, how much revenue turns into profit.
And how did the sector stack up?
Interestingly, on average, ROE, consumer discretionary, slightly trailed the S&P 500. But based on the data provided, it actually outperformed the broader market on average EPS growth, ROA, and net profit margin.
That's curious. So maybe growing earnings faster and using assets well, but perhaps less efficient with shareholder equity on average?
Yeah.
Could that be due to, like, high investment needs or something?
That's one possible interpretation of the averages. It could be influenced by the capital structure, maybe higher debt levels in some parts, or just the inherent volatility. Then when you look at valuation ratios, things like price to earnings, PE, how much you pay for earnings, and price to book, PB, market price versus asset value.
The sector looked kind of expensive, right? Pricier than the S&P 500.
It did, yeah. The average PE and PB for consumer discretionary were higher than the S&P 500 average in that data set. This could mean investors are paying a premium, maybe expecting strong growth when the economy's good, but it does raise potential flags about overvaluation compared to the market as a whole.
But then you have the absolute giants in the sector, like Amazon, AMZN, and TJX companies, TJX. The sources highlighted them as key holdings in the Whizman fund.
Right, these are massive companies. Amazon's market cap was like $1.8 trillion, TJX over $100 billion. And the sources make a point that these big players, AMZN, Tesla, Home Depot, often show much stronger financial metrics than the sector average. Better ROE, ROA, margins, growth.
And their valuations probably reflect that too.
Oh, absolutely. Their PE and PB ratios are often way higher than even the sector average, reflecting those high expectations. Amazon, for instance, had just incredible performance numbers, both recent and long-term in the data shown. TJX also showed really solid long-term returns.
So the takeaway is, while the sector average might look pricey or mixed on some metrics, the individual giants can tell a very different story.
Definitely. The leaders can really pull the whole sector along, but you absolutely have to look at their individual fundamentals and valuations. Their size often helps them weather the cycles better than smaller firms too.
Okay, given all that complexity, the cycles, the economy, the sector averages versus the giants, the valuations, what was the strategic recommendation from this particular source for consumer discretionary?
The report recommended basically an equal weight position, meaning they suggested holding the sector at roughly the same percentage it represents in the S&P 500 index, which was around 10.3% at the time.
And the thinking behind that?
It was about balance, balancing the potential upside if the economy stays strong or recovers against the downside risk if things slow down, given the sector's tendency to underperform in downturns. They suggested achieving this by holding on to strong existing positions like AMZN and TJX, maybe adding more, or finding similar high-quality names to reach that target weight, or simply maintaining the current weight if already there.
Okay, makes sense. Managing risk. Now let's switch gears completely, from consumer wallets to, well, industrial gears, the industrial sector. How does this fit into the cyclical narrative?
Industrials are another classic cyclical sector, absolutely tied to the broader economy, but maybe driven more by business investment and government spending rather than just individual consumer choices. It's a really broad category, too. Aerospace and defense, companies making heavy machinery, transportation firms like airlines, railroads, shipping, and also commercial services providers, everything from waste management to consulting.
So when businesses feel good and start investing, or when governments launch big infrastructure projects, this sector should do well.
That's the idea. Its performance is highly linked to the pace of economic growth, especially those big-ticket capital investments by companies and major government initiatives. Just like consumer discretionary, it tends to outperform when the economy is expanding and underperform when it contracts.
How is the industrial sector typically broken down for analysis?
According to the S&P Industrial Index breakdown in the sources, it's mainly split into three chunks. Capital goods is the biggest by far, roughly 69%. Then you have transportation at about 16%, and commercial and professional services making up the remaining 15% or so.
So capital goods really dominates.
It does, and the sources suggest that if you're investing here, diversifying across these different subsectors might give you a more balanced exposure to the whole industrial economy.
What are the big long-term trends that could really push this sector forward? What are the tailwinds?
There are several pretty powerful ones. A big one is government spending on construction and infrastructure. Think roads, bridges, grids. Legislation like the Infrastructure Investment and Jobs Act and the Inflation Reduction Act in the U.S. are specifically designed to boost this, creating huge demand for materials and equipment.
Okay, what else?
The ongoing shift towards manufacturing and factory automation is another. Companies are investing heavily in robotics and smarter factories, which requires a lot of capital goods. Then there's increasing regulation focused on energy and fuel efficiency. That drives demand for things like efficient HVAC systems, smarter building management, and more fuel-efficient planes and trucks.
Growth overseas matters too.
Definitely. Growth in developing countries and the rise of a global middle class generally increases demand for all sorts of manufactured goods, transportation, and the infrastructure needed to support it all.
Were there specific areas within industrials that the sources pointed to as looking particularly interesting?
Yeah, they highlighted a few. HVAC, heating, ventilation, air conditioning see strong demand because buildings need upgrades to more energy efficient systems. That's driven by environmental rules, but also just saving money on energy. In aircraft, airlines have aging fleets, and fuel is a massive cost, so there's pressure to buy newer, more efficient planes,
And construction.
especially related to those big public works projects we mentioned. That directly benefits the companies making heavy equipment and the suppliers feeding into those projects. The report even listed some specific companies with positive ratings tied to these themes.
Now, the report mentioned that the S&P Industrial Index had actually outperformed the broader S&P 500 over the previous 3 years.
Yeah, that's an important bit of recent history. That outperformance was apparently driven by strong results in areas like aerospace and defense, building products, machinery, and electrical equipment. It just shows that even within a generally cyclical sector, specific industries can have their own strong runs, especially if they're catching specific tailwinds like government spending or tech upgrades.
And just like with consumer discretionary, getting the timing right with industrial seems absolutely crucial.
Absolutely. Maybe even more so because capital investments can be so large and, well, lumpy. The whole idea of industrial cycles follows that same leading indicator pattern we discussed. The sources even had a diagram showing how stock prices typically lead earnings. The stock price starts moving up before the company's profits actually bottom out.
And it starts falling before profits peak.
Often, yes. The stock price often declines before earnings hit their highest point.
So, again, if you wait for the quarterly reports to show booming profits and everything looks great, you might have already missed the boat on the stock price move.
That's exactly it. The implication, according to this analysis, is that the best time to consider buying a cyclical industrial stock is often when the news still sounds pretty grim, when sentiment is low, when things feel pessimistic.
Buying when it feels bad.
Right, buying when things feel great, when earnings are peaking and the economy seems unstoppable. Well, that's probably when the stock price has already factored all that good news in and might actually be closer to a top. It feels completely backward, but that's how leading indicators work.
The sources also gave a quick nod to ESG considerations being relevant here.
Yeah, it makes sense. Industrial companies often have big manufacturing footprints, deal with waste, emissions, use lots of resources, employ large workforces. So environmental, social, and governance factors, ESG, are definitely things investors are increasingly looking at when evaluating these companies.
Okay, so we've defined cyclicals, we've talked about the economic cycle, we've done deep dives into consumer discretionary and industrials, their drivers, performance, all that. Now for the really, really tricky part, how do you actually try to navigate this? How do you attempt to time these cyclical investments?
Yeah, and the sources are pretty blunt about this. Precise timing is really, really difficult. Economic cycles just aren't neat and tidy. They vary in how long they last, how high they go, how low they dip. And because stock prices move ahead of the fundamentals, if you wait for clear economic data or proof of earnings improvement, you've likely already missed a big part of the price move.
So it's tough. What tools or approaches do the sources suggest might help someone get a handle on timing, even if it's not perfect?
Well, one approach they discuss is using technical indicators. These basically analyze past price and volume data, looking for patterns or shifts in momentum. The specific one mentioned is the Monthly Relative Strength Index, or RSI.
The RSI. How would someone use the monthly RSI for a cyclical stock? What's the idea there?
The concept presented is that when the monthly RSI dips below a certain level, say 40, it could signal that the stock is getting oversold, maybe hitting a cyclical low point, potentially entering a buying zone.
Could, so it's not a guarantee.
Not at all. And critically, the signal is often considered much stronger, more reliable, if the RSI doesn't just dip below 40, but then decisively breaks back above 40. That upward break is seen as a potential confirmation that momentum might really be shifting back in a positive, sustainable way.
Okay, so dipping below 40 is a maybe. Breaking back above 40 is a stronger signal. What about signaling a potential peak or time to sell?
Conversely, when the monthly RSI climbs up high, say above 60 or even 70, it could suggest the stock is becoming overbought, maybe nearing the peak of its cyclical run. That might be a time to consider reducing your position or even getting out. The sources use some conceptual examples, NALLCO and SOBA, I think they're Indian companies. But the technical principle is the same, illustrating how RSI patterns might map onto cyclical price moves.
So the RSI isn't about predicting the exact price. It's more about gauging sentiment and momentum shifts,
Yeah.
trying to spot potential turning points.
Exactly. It's trying to identify those inflection points. The other approach mentioned in the sources uses fundamental valuation metrics, specifically metrics that tend to swing wildly over the cycle but often snap back or revert to some historical average over the long run. The main example given was price-to-book ratio, or PB.
Right. The idea being if a stock is trading way below its typical PD ratio, maybe it's cyclically cheap. And if it's way above, maybe it's expensive.
That's the core logic. The sources showed examples where, hypothetically, buying when the PB was really low, maybe below 1, or even down around zero point 0.6 in their examples, and then selling when it got high, say, around 2 could potentially capture those big cyclical swings. It relies on the assumption that the market's valuation of the company relative to its assets will eventually gravitate back towards its historical norm.
But this approach sounds like it comes with some pretty big warnings attached.
Huge warnings, and the sources were very clear here. They explicitly caution that it involves fitting old data and expecting the future to turn out like the past, which, is always risky. You can easily overfit.
And the even bigger risk.
Maybe the most fundamental risk is that this strategy only works if the company you're buying is actually strong enough financially to survive the downturn. A company drowning in debt or with weak underlying business, well, it might not even make it to the next upcycle, no matter how cheap its stock looks on a PB basis when things are bad.
So a strong balance sheet is absolutely essential for this kind of cyclical value investing.
Paramount. Non-negotiable if you're trying that strategy.
Okay, so those are some potential tools for timing, albeit with major caveats. Let's bring this right up to the present. The sources included some very current economic data from the Conference Board, specifically their U.S. leading economic index, the LEI, based on April 2025 data.
Right, and the LEI is designed specifically to be predictive. It pulls together a bunch of different forward-looking indicators, things like manufacturing orders, building permits, consumer expectations, stock prices, to try and forecast turning points in the economy several months out.
And what did the April 2025 data show?
It showed a pretty significant weakening, actually. A 1.0% drop just in that month, which was the biggest monthly decline they'd seen since March 2023. And the 6-month annualized growth rate was also negative, sitting at negative 2.0%, same as the prior 6 months.
Wow, a 1% drop in a month sounds like a clear warning signal about where growth might be headed.
It absolutely is. The Conference Board's report explicitly highlighted widespread weakness across most of the things that go into the LEI. Average weekly hours worked in manufacturing, building permits, new orders from manufacturers, how consumers felt about future business conditions, even stock prices, they all deteriorated in April. This led the Conference Board to issue a clear warning signal for growth.
Okay, a warning signal. Does that weakening LEI mean a recession is definitely on the horizon, according to their specific analysis?
Not necessarily yet, based on how the Conference Board formally defines a recession signal. They have this criteria they call their 3Ds rule. It looks at the duration, the depth, and the diffusion of the LEI's decline.
Duration, depth, the diffusion.
Right.
Okay.
To trigger their formal signal, the 6-month growth rate needs to fall below a specific depth threshold, which they set at negative 4.1%. And at the same time, the diffusion index, which measures how widespread the weakness is across all the LEI components, needs to be at or below 50, meaning at least half the components are declining.
So the April data showed a negative 2.0% 6-month growth rate. That's negative and getting worse.
Yeah.
But it hadn't hit that negative 4.1% depth threshold yet.
Correct. And while the report did say the weakness was widespread, suggesting the diffusion index was probably low, though the exact number wasn't in our excerpt, both conditions have to be met simultaneously for them to flash the formal recession signal. So, bottom line, it's a strong warning, clearly points to slowing momentum and rising risks for the economy, but based purely on the April data, it hadn't yet triggered their specific formal recession is likely imminent or underway signal.
Interesting. And the coincident index tracking current conditions was still slightly positive.
Yeah, which suggests the economy was still growing, albeit maybe weakly in the present, even as the leading indicators were flashing yellow or maybe even orange.
So how do we tie this very current economic picture, this weakening LEI, back to our whole discussion about cyclical sectors like consumer discretionary and industrials?
This is where it gets really challenging and honestly quite crucial for you, the listener, to think about. A weakening LEI like this strongly suggests the economic winds are shifting, becoming less favorable for growth.
Which should be bad news for cyclicals.
Generally, yes. Given how sensitive these sectors are to economic momentum and business spending, this data points towards potential headwinds ahead. Demand for new cars, fancy restaurant meals, vacations, big machinery, new factories. All that could face pressure if this weakening trend continues or gets worse.
But earlier, we spent a lot of time talking about how the stock market leads the economy and how the supposedly best time to buy cyclicals is often when the news sounds pessimistic.
Exactly. And this is the analytical tension, the puzzle you have to wrestle with. The LEI is showing pessimism. It's a warning signal. Historically, periods of economic pessimism can sometimes be the prelude to rebounds in cyclical stocks, precisely because the market starts anticipating the next recovery way out in the future.
So the big question is this current weakness just a temporary blip, or is it the start of something deeper that will really hammer earnings? And have stock prices in these sectors already fallen enough to reflect this weakness, maybe creating an opportunity, or are they still priced for the good times we just had?
That's the crux of it. It forces you to balance that negative incoming economic data, like the LEI, against the market's forward-looking nature and that potential counterintuitive timing strategy for cyclicals.
This is not simple.
Definitely not simple. You're weighing the signal of slowing growth against the possibility that the market might look past that weakness towards an eventual recovery. It really demands careful analysis, not just of the big macro picture, but drilling down into the specific fundamentals, the current valuations, and crucially, the balance sheet strength of the individual companies within consumer discretionary and industrials.
Wow, okay. That really brings it all together and leaves us with something pretty significant to chew on. We've covered a lot of ground today. We defined cyclical stocks, talked about how they kind of dance with the economic cycle, the whole idea of sector rotation. We did those deep dives into consumer discretionary and industrials, their drivers, the challenges, performance patterns, financials, valuations, all based on these sources. And we looked at potential tools for navigating the timing RSI, PB acknowledging they're far from perfect. And maybe most importantly, we connected it all to the very latest leading economic signals.
Yeah, I think the key takeaways for you listening are cyclical stocks, especially in these two big sectors, are just fundamentally tied to the economy's rhythm. If you're going to invest here, success often involves understanding the different stages of the economic cycle, knowing how these sectors tend to behave in each stage, and then combining that big picture view with really solid analysis of the actual companies, their fundamentals, their valuation.
And the timing.
Timing is tough, no doubt, because prices move first. But tools like leading indicators, the LEI is a prime example, along with technical analysis like RSI or valuation analysis like PB, they can offer valuable clues. They won't give you perfect answers, but they can help inform your thinking as you try to position yourself. And always, always remember diversification and the absolute importance of strong balance sheets. Companies need to be able to survive the winter to enjoy the spring.
So let's end right there on that really thought-provoking note you raised. If we accept that stock prices are leading indicators, often moving months ahead of the economy, and if the classic, maybe counterintuitive advice for cyclicals is to consider buying when the news feels pessimistic, how do you, listening right now, take these current economic warning signals, like the weakening U.S. LEI data we just discussed, and try to square that with maybe the recent performance of these sectors or the current, perhaps still high, valuations of individual giants like Amazon or major industrial companies?
That's the core challenge, isn't it? The constant balancing act in cyclical investing. It's not a simple formula you can just plug numbers into. But hopefully by understanding these dynamics, the cycle itself, the sector's relationship to it, that tricky timing paradox, and the indicators we have, you're much better equipped to make informed decisions as you navigate these inevitable economic waves.
Absolutely. It really is about understanding that complex rhythm of the market and the economy. Thanks so much for diving deep with us today.
My pleasure. Always interesting stuff.
We'll catch you on the next Deep Dive.